Let's be real, nobody wants to work forever. We all dream of financial freedom, right? Investing is your ticket to that dream. It's about making your money work for, not the other way around. Think of investing like planting a tree. A small seed today grows into a mighty oak over time. Similarly, even small investments made consistently can blossom into significant wealth. The earlier you start, the better. Time is your greatest ally in this game. Don't wait for that perfect moment or a huge pile of cash. Start small, start now, and watch your money grow. But Ramit, you say, I can barely afford rent. How can I possibly invest? Stop right there. Investing isn't just for the wealthy. It's for anyone serious about building a brighter future. We're not talking about dropping thousands on Wall Street. You can start with as little as $5. Yes, you read that right. $5. It's about building the habit, understanding the game, and watching your money multiply. Forget fancy suits and jargon-filled meetings. Investing is accessible to everyone, regardless of income. So ditch the excuses and let's get you started. Before you even think about stocks or bonds, you need a solid foundation, a budget. It's not about deprivation, it's about control. Knowing where your money goes is the first step to freeing up cash for investing. Track your spending for a month, every coffee, every subscription. You'll be surprised where your money disappears. Identify areas to cut back. That daily latte could be fueling your investment portfolio. Automate your savings. Set up a system where a small amount is automatically transferred to your investment account each month. You won't even miss it, and your future self will thank you. Now for the fun part, putting your money to work. It's time to explore the various avenues where you can park your cash and watch it grow over time. Don't overcomplicate things, especially when starting out. Simplicity is key, and there are plenty of straightforward options that can help you get started on the right foot. There are simple, low-risk options perfect for beginners. These options provide a safe way to grow your money without taking on too much risk. High-yield savings accounts offer a better return than traditional savings accounts. They are a great place to start if you want to earn a bit more interest on your savings. They are FDIC insured, meaning your money is safe. This insurance protects your deposits up to a certain limit, giving you peace of mind. It's not the most exciting option, but it's a solid start. Your money will be safe and earn a steady return, which is perfect for those just beginning their financial journey. Certificates of deposit, or CDs, offer a fixed interest rate for a specific term. This means you know exactly how much interest you'll earn over the term of the CD. You'll earn more than a savings account, but you'll need to lock your money away for a while. The longer the term, the higher the interest rate typically is. Money market accounts offer a variable interest rate, usually higher than savings accounts. These accounts are a good option if you want to earn more interest but still have access to your money. They often come with check writing privileges and debit cards, making them a convenient option. This means you can use your money when you need it while still earning a higher interest rate. As you become more comfortable with these basic options, you might consider exploring other investment opportunities. Diversifying your investments can help you achieve higher returns over time. Remember, the key to successful investing is to start early, stay informed, and be patient. Your money can grow significantly over time if you make smart, informed decisions. So take the first step today. Park your cash in a safe, low-risk option and watch it grow. Your future self will thank you for making these smart financial choices now. Section 5, Diving Deeper, ETFs and Robo-Advisors. Explained. Ready to level up? Let's talk about exchange-traded funds, or ETFs. These are like baskets of stocks, offering instant diversification. They're easy to buy and sell, making them perfect for beginners. Robo-advisors are your automated investment gurus. They build and manage your portfolio based on your goals and risk tolerance. They're low cost and require minimal effort, perfect for hands-off investors. Remember, knowledge is power. Take the time to understand these options before jumping in. Read research, and don't be afraid to ask questions. Section 6. Real talk examples of low-cost investments. Let's get specific. Investing doesn't have to be expensive or complicated. In fact, there are several low-cost investment options that can help you grow your wealth without breaking the bank. Let's dive into some of the best choices available. Here are some low-cost investment options to get you started. Vanguard S&P 500 ETF VERO. This is one of the most popular ETFs out there, and for good reason. This ETF tracks the S&P 500, a collection of 500 large US companies. By investing in VERO, you're essentially buying a small piece of each of these companies, which includes some of the biggest names in the business world, like Apple, Microsoft, and Amazon. It offers broad market exposure at a low cost. The expense ratio for VEO is just 0.03%, meaning you only pay $3 a year for every $10,000 you invest. This low cost can make a big difference over time, allowing more of your money to stay invested and grow. Another great option is the Schwab Total Stock Market Index, SWTSX. This fund is designed to give you exposure to the entire US stock market. This ETF tracks the entire US stock market, providing even broader diversification than the S&P 500. With SWTSX, you're not just investing in large companies, but also mid-sized and small companies, giving you a more comprehensive view of the market. Fidelity Zero, Large Cap Index, FNILX, is another excellent choice. What sets this fund apart is its 0% expense ratio. This index fund has a 0% expense ratio, meaning you pay nothing in fees. That's right, zero. This can be particularly appealing for new investors who are looking to maximize their returns without worrying about fees eating into their profits. It tracks the performance of large US companies, similar to the S&P 500, but without the cost. This makes it an attractive option for those looking to invest in well-established companies without incurring additional expenses. These are just a few examples, and there are many other options available. The key is to find investments that suit your individual needs and financial goals. Do your research and choose investments that align with your goals and risk tolerance. Remember, the best investment strategy is one that you understand and feel comfortable with. Take your time, explore your options, and make informed decisions to build a strong financial future. Section 7. Don't put all your eggs in one basket. Diversification 101. Imagine putting all your money into a single stock. What happens if that company tanks? You guessed it, your entire investment goes down the drain. That's why diversification is crucial. Diversification means spreading your money across different asset classes, stocks, bonds, real estate, and within those asset classes, different sectors, countries, company sizes. By diversifying, you reduce the impact of any single investment on your overall portfolio. It's like having a safety net for your money. Section 8. Time is money. The magic of compound interest. Compound interest is like magic, but instead of pulling a rabbit out of a hat, it pulls money out of thin air. Imagine you have a small amount of money and you invest it. Over time, not only does your initial investment earn interest, but that interest also earns interest. It's a cycle that keeps on giving. It's the interest earned on your initial investment plus the interest earned on that interest. This means your money grows faster than it would with simple interest, where you only earn interest on your initial investment. Think of it like a snowball rolling downhill. At first it starts small, but as it rolls, it picks up more snow, growing larger and larger with each turn. It starts small, but as it gathers more snow, it grows larger and larger. Similarly, your investment starts small, but as it earns interest, and that interest earns interest, it grows exponentially. The longer you invest, the more your money compounds, leading to exponential growth. This is why time is such a crucial factor in investing. The earlier you start, the more time your money has to grow. This is why starting early is so powerful. Even if you start with a small amount, the magic of compounding can turn it into a significant sum over time. Even if you can only invest a small amount, the magic of compounding will work its wonders over time. The key is consistency and patience. Regularly adding to your investment, even in small amounts, can lead to substantial growth. So start now and let the magic of compound interest work for you. Section 9. Stop dreaming, start doing. Your journey begins today. You've got the knowledge, you've got the tools. Now it's time to take action. Open an investment account, set up automatic transfers, and start investing. Even if it's just a few dollars a week, it's a step in the right direction. Don't let fear or procrastination hold you back. The world of investing may seem daunting at first, but with a little effort, you can master it. Remember, the best time to plant a tree was 20 years ago. The second best time is today. Section 10. Key takeaways, investing wisdom for the newbie investor. Investing is for everyone, regardless of income. Start small, even with $5, and build the habit. Budgeting is key to freeing up cash for investing. Diversify your investments to reduce risk. Time is your greatest ally. Start early and let compounding work its magic. Investing is a journey, not a sprint. There will be ups and downs, but with patience and persistence, you can achieve your financial goals. Now go out there and start building your future.